Brad Williams. Frugal Finance, FRA pricing. As their name implies, forward rate agreements are forward rate instruments and are priced using forward rate principles. Continuous compounding, I kept bringing to your attention forward rates. Why we have to focus on forward rates, but I didn't mention anything about how to price these things. Maybe this short example will answer that question. So consider an investor who has two alternatives, either a 6-month investment at 5% or a 1-year investment at 6%. If the investor wishes to invest for 6 months and then roll over the investment for a further 6 months, what rate is required for the rollover period such that the final return equals the 6% of available from the 1-year investment? If we view an FRA rate as the break-even forward rate between the two periods, we simply solve for this forward rate, and that is our approximate FRA rate. This rate is sometimes referred to as the interest rate gap in the money market, not to be confused with the interbank desk gap risk, the interest rate exposure arising from the net maturity position of its assets and liabilities. Now, we can use the standard forward rate break-even formula to solve for the required FRA rate. We established this relationship earlier when discussing the calculation of forward rates that are arbitrage free. This relationship given in equation 2.0 connects the simple bullet interest rates for periods of time up to 1 year where no compounding of interest is required. As FRAs are money market instruments, we're not required to calculate rates for periods in excess of 1 year where compounding would need to be built into the equation. This is given by equation 2.0. This is the simple approach, but derivatives need forward rates out to 3 to 4 years. That brings into a lot of complexity in terms of determining and calculating forward rates. That being said, here's the formula. 1 plus R T2 equals 1 plus R1 T1 times 1 plus R1 T1. R2 is the cash market interest rate for the long period. R1 is the cash market interest rate for the short period. RT, I think that's a T, it might be enough. R of F is the forward rate for the gap period. T2 is the time period from today to the end of the long period. T of 1 is the time period from today to the end of the short period. T sub F is the forward gap time period or the contract period. So you have R1, RFRA, R2, start, T1, T2. And I may have said R of F, I don't think I'm too far off there. Here are some, just an illustration. The time period, T of 1, is the time from the dealing date to the FRA settlement date, while T of 2 is the time from the dealing date to the FRA maturity date. The time period for the FRA contract period is time T2 minus T1. We can replace the symbol T for time period with N for the actual number of days in the time periods themselves. If we do this and then rearrange the equation to solve for RF of A, FRA rate we would obtain is this, where you can read this on your own. So if the formula is applied to say the money market, 365 in this equation is replaced by 360, the day count base for that market. In practice, FRAs are priced off the exchange traded short-term interest rate futures for that currency, so that sterling FRAs are priced off of life short sterling futures. Traders normally use a spreadsheet pricing model as future prices directly fed into it. FRA positions are also usually hedged with other FRAs or short-term interest rate futures. Now you're saying, well, Brad, wouldn't a real example be more helpful? Maybe that's next. Brad Williams, Frugal Finance. See you soon.